Equity Market Update, January 2021. After rising over the past few months, equity markets took a breather and Nifty 50 ended the month approximately 3% lower compared to the last month. The market was influenced by uncertainty around the budget, new strain of virus, fresh lockdowns in advanced economies, optimism around additional fiscal stimulus by the US, continued demand of domestic economic activity, etc. The mid-caps and small caps outperformed large caps during the month. Among sectoral indices, auto, capital goods, and IT ended the month in positive, while healthcare, metal, and banks closed in negative. Globally, the performance was mixed, with key US and European market indices ending the month in negative, while Asian indices delivered positive returns. During the month, FPIs bought equity worth $2.7 billion as compared to net inflows of $9.3 billion in the previous month. Cumulative FPI inflows into equity increased to $29 billion in 10M FY21, as against net inflows of $10.8 billion in a similar period last year. Domestic equity-oriented mutual funds recorded net outflows of INR 14,901 crore in January 2021, compared to net outflow of INR 18,486 crore a month ago. In the first 10 months of FY21, net outflows from domestic equity-oriented mutual fund schemes was INR 69,217 crore as against net inflows of INR 42,927 crore during the same period last year. Out of the results declared for Q3 FY21, results for banks, NBFCs, consumer staples, metals, and consumer durables were better than expected. Results of oil and gas, pharma, telecom, auto, infrastructure, and industrials were largely in line with expectations. Outlook. As on 31st January 2021, Nifty 50 was trading near 21x FY22E and 17.7x FY23E price to earnings ratio. In our view, these are reasonable multiples, especially given the low interest rate environment and improving economic activity. Further, the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield continues to remain below its 10-year average. The Nifty 50 rallied significantly post-budget, driven by pro-growth announcements and focus on capital spending. While Nifty 50 is now higher than pre-COVID level, it should be viewed in the context that the 10-year and 15-year Nifty 50 returns are approximately 11% CAGR, largely in line with growth in nominal GDP. The rally is further supported by broad-based upgrade in corporate earnings over the past few months, as the impact of COVID-19 was much lower than earlier anticipated. Q3 FY21 has turned out to be one of the best earnings season in the last 6 years, so far with PAT growth of 32%. While the rally has been sharp, it has been relatively polarized, with top 5 stocks accounting for a high proportion of returns. In the past, it has been observed that such a phase of polarized returns is followed by broader markets outperforming Nifty 50. While this is seen from historical data, the same may or may not sustain in future. Polarized market returns are also visible in divergence in sector valuations, as reflected in rising standard deviation amongst the valuation multiples across sectors over the past few years. The polarized returns have also resulted in significant divergence in valuations across sectors compared to their long-term average. Further, the budget, with its focus on growth and capex revival, augurs well for new investment cycle and corporate credit growth. Divergence in returns of sectoral indices post-budget reflects the same. Hence, Markets hold promise over the medium to long term, in our opinion. Good sequential improvement in economic activity, comfortable external scenario, monetary and fiscal measures undertaken along with relatively better placed rural economy also supports this optimism. In view of the above, in our opinion, there is merit in increasing allocation to equities in a phased manner or in staying invested as the case may be for those with a medium to long-term view and in line with individual risk appetite. Significant rise in spread of COVID-19, unwinding of expansionary fiscal and monetary stimulus, good rise in crude oil prices, higher than expected NPAs post the moratorium, escalation of border tension between India and China and/or trade tension between US and China, significant policy changes post-US elections, etc. are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.